Welcome to 3 and 3. My name is Jason Weaver. Today we're going to be talking about 3 drivers of performance: active versus passive investing, and portfolio rebalancing. Asset allocation. Asset allocation is the mix of assets to hold in a portfolio for an optimal risk-return balance based on a risk profile and investment objectives. According to most actual studies, 91.5% of the difference between portfolio performances are explained by asset allocation. A lot of people put focus on security selection, which is also somewhat important more in the short term, which is identifying individual securities within your portfolio, and also market timing, which is trying to time when is the right time to buy and sell a specific security. So again, the 3 most important things when you're looking at the drivers of performance are going to be market timing, security selection, and asset allocation. And spend most of your time on asset allocation because that's the most important over the long term. Active versus passive investing. So passive investing is an investment strategy to maximize returns by minimizing buying and selling. The strengths is, again, it has low fees, transparency, and tax efficiency. Active investing refers to an investment strategy that involves ongoing buying and selling activity by the investor. The strengths, again, are the flexibility, the hedging, and potential risk management. Looking at a chart here that goes back to 1987, the gray is the actual passive investing, and the orange is the active investing. And what you're seeing is that during certain periods of time, active investing outperforms passive investing. And we're looking at the large cap blend index. The key that we have found is what you want to have in a manager is a high active share. And what that means is they're not a closet indexer. If you look at that index, they have a different mix of stocks, and it doesn't necessarily look like the index that they're tracking. Portfolio rebalancing. So portfolios tend to drift over time. Their weight shift due to market performance. The bull market in stocks would have increased their weight over time relative to other assets. So regular balancing is important to keep these allocations in line with your financial goals. All right. So what we're looking at here is a chart explaining portfolio drift going back to 2009. And we're looking at different asset allocation models. The first model is a 80% stock and 20% bond portfolio. And that drift from 2009 to 2022 is now we have a 95% stock portfolio. Looking at a 60% stock portfolio, that is now 87% stocks. A 40% stock portfolio is 75% stocks, and a 20% stock portfolio is now 52% stocks. So this just shows you how important it is to rebalance your portfolios at least once a year.